Let's shift focus to the industrial space now. We have Jefferies investor feedback, which is suggesting that budget 2024 will be closely watched. They don't see a material sort of deviation from the capex spend that we've seen over the last couple of years from the government of India. We have Lavina Quadras. She's managing director of research, capital goods, utilities and logistics at Jefferies, joining us now. Great to have you with us here, Lavina. Good morning. Prashant this side. You know, let me just get this, what you put out on the 4th of June. You said, well, as far as industrials are concerned, you're essentially the advice is be selective, power and defense stand out, and these should do well. So, you know, just to begin with, before we dive into details in terms of your thinking, etc., what do you like in these two spaces, power and defense, Lavina?
So good morning, everyone. Firstly, I will not be able to comment on specific stocks. But just coming to the broader theme, right? What we believe is that the power deficit is here to stay. We believe that FY24 to 30, the power sector as a whole will see the strongest growth. We're also positive on the defense side. See, in defense, one of the things we highlighted in our note was it's not really an increase in the budget spend, but essentially what is happening in defense is the whole focus on domestic manufacturing, import substitution. So that should continue. And defense exports, as far as that is concerned, that could provide an additional leg of upside to companies in the sector. So net, we believe that the capex focus of the government will continue, though the budget will be an important indicator as to directionally how much that focus remains.
Right. I mean, you know, we are one of the biggest, actually, we are the largest importer, right? Defense importer in the world, I think. And if you try and make more and more of what we import locally, I mean, of course, the runway is going to be very large. The opportunity could be very large, of course, over a long period of time. But what are stocks pricing in, without naming names, Lavina? Is there a long runway here for stocks as well, or a lot of it is in the price?
So I do think that there is still a lot of runway left. So again, like I mentioned, I can't comment on stocks specifically, but just on the broader theme, right? One of the things we had even put out in our report is India is still one of the largest importers, and essentially domestic manufacturing and import substitution should continue, which means that companies should have a runway of double-digit growth ahead for, again, at least the next 4 to 5 years. So let's say within the broader capex theme, right, defense stocks, and power equipment related stocks should be the biggest beneficiaries, of this trend and focus that the government has. See, for me, defense exports is a very interesting area as well. So while it's being discussed, larger orders are yet to come for the companies. So that could give you an additional leg of upside, again, over the next 4 to 5 years.
Okay. So the order inflow for most of the industrial stocks, right, in FY24 went up about 35% year on year. Keeping the budget aside, just purely in terms of order inflows, what is the expectation? Do you think FY25 can be a better year compared to FY24?
So what you need to bear in mind, again, coming to what probably stocks are pricing in, right? For me, as long as double-digit growth continues on the order flow side, and it may be lower year on year because you did have, let's say in 21-22, there was some COVID impact on the ordering, right? Which has reflected in base effect, and therefore you've had stronger growth probably in 23 and 24 when the cycle has just started. But so growth year on year might be directionally lower, but it will not matter as long as it is in double digits, because what will end up happening is there's still a lot of operating leverage left in the system. So essentially on double-digit top-line growth, you still have potential of earning surprises ahead for the next 18 to 24 months. So again, I mean, if you're present in the stock, which is, you know, where the end client is in the right sector, you still have more runway for both growth as well as share price upside.
All right. Hi, Lavina. Good morning and good to see you in. Thanks a lot for joining in on the show. Well, I wanted to ask you about the industrial space. You know, there's a bit of a re-rating that's taken place out there, but particularly PSU industrials. You know, they have narrowed that gap with the non-PSUs. I think it used to be around 35-40%. That's come down to, I think, around 10% in terms of PE. Do you think the PSU industrials have run ahead of themselves?
Morning. So for me, again, without coming into stock names, the idea is there are some PSUs which are actually showing very, very good growth prospects, right? They've seen upgrades in earnings over the last 18, 24 months. So for me, this run-up and this re-rating, a lot of it is based on and contingent on earnings upgrades continuing. So for me, again, even, PSU, definitely the gap has narrowed down with the private sector. But if the PSUs continue to surprise on earnings, and for example, in power companies, if they surprise on capacity addition, and if their industry bid pipeline is rising, you should continue to see upside in these names, even from current levels.
Lavina, when I'm looking at your recommendations and where your target prices are, right? I'm looking at HAL, BEL, defense first, and maybe you can throw in L&T as well because they have a defense business. You said many years of 20% kind of growth possible here. The targets are around where the prices are. I mean, the prices are moving up so fast. So just wanted your thoughts here. I mean, is it, how do you reconcile both?
No, so what will happen is we will wait for earnings season. We will review at that point in time. So in that sense, we'll have a look at target prices. But just in terms of directional, right, like I was mentioning, you still have a lot of runway for growth ahead.
In power, because there are utilities, there are power equipment companies, space areas like transformers, etc. Power financiers, a lot of the financing needs will be met by Indian entities. What's the best way to play this theme? Because there is a lot of capacity addition which needs to happen without naming names again.
Again, the note that you were referring to, right? One of the things we highlighted over there is industrials, if you think about it, is fairly well owned. A lot of investors, both globally and in India, own industrials. I'm not saying they don't own power, but the broader sense we got was that, from investors is power, as far as ownership is concerned, there is still probably some way to go. And if you ask me if you're in the right names, right, I think you should be owning the asset owners as well, which are companies that will execute. The way to look at asset owners or the power companies is that their earnings growth should mirror their execution growth. So if one believes that power deficit is here to stay on the peak level and government focus on power capex continues, those companies that actually execute and increase their asset base are the ones which will see the higher earnings growth. So for me, I think you should be present in all the legs, right? You should own the asset owners, you should own your industrial names as well. Finances, I don't cover, so I'd not be able to comment over there. But just within, I would want to be present in both the asset owners as well as the equipment vendors.
Some of your coverage, of course, also it does sort of take into account the renewables opportunity, right? I mean, companies like NTPC, etc., also, of course, are executing on the renewable side in a big way. Are you positive on that space? Because there are individual companies, smaller companies, which, of course, you guys don't have coverage on, which have done very well. So just your thoughts there. And when you talk renewables, what are you most sort of constructive on? Solar, wind?
So one of the things we mentioned in our piece, right, we're looking forward to power sector as a whole, seeing the highest growth capex, CAGR, let's say, within all the capex subsegments within India, right? And the idea there is renewable will definitely be a very big driver. So again, in our own assumptions, we have renewable energy. We believe industry level, the renewable energy capacity is likely to rise more than 3 times. So for me, again, you will have beneficiaries on the asset owner side. And of course, on the equipment chain, India is looking, to backward integrate. You have larger corporates that have discussed plans in solar module manufacturing and even to backward integrate within there, right? So clearly you will have chain beneficiaries as well, including the smaller ones. And like I mentioned, even growth for them has a fairly long runway of double-digit growth, at least for the next 4 to 5 years, keeping in mind that, this peak deficit should continue. So for me, as long as power demand is growing at 7% and above, the story is very much intact.
Okay, before we let you go, Lavina, the big event upon us, the union budget. From your sector point of view, what are the key expectations?
So see, as far as the interim budget was concerned, 16% year-on-year was the capex growth approximately. So we're looking forward to this staying in double digits, and the capex focus, the government capex focus on the budget, in the budget continuing.
All right, Lavina, we'll leave it there. Great conversation, and I hope we can do this more often. Appreciate you joining us here on CNBC TV 18. Thanks indeed.